silver at $120, gold at $6,000 in the dark market. And most investors in the United States are still staring at Friday's closing prices like nothing changed. Let me be very clear with you right now. When physical markets are trading that far above paper markets, something is breaking beneath the surface. This is not noise. This is not hype. This is a warning signal flashing in real time. If you care about protecting your money in a system that is shifting fast, hit the like button and subscribe right now. On Past and Profit, we connect global shocks to hard asset strategy before the mainstream financial media catches up. This channel is about facts, logic, and positioning early, not reacting late. Now let's talk about what is actually happening. Over the weekend, while traditional futures exchanges were closed, physical and tokenized markets kept trading. Crypto rails never sleep. Physical dealers in Asia never fully shut down. And that is where the real price discovery started to move. Gold touched $6,000 per ounce in dark market trading. Tokenized gold instruments traded above 5,400, more than $120 above Friday's official close. Silver in Shenzhen. Physical markets traded north of $120 per ounce. Meanwhile, Western paper silver closed at 93. Think about that gap for a moment. Nearly $30 difference between what paper says silver is worth and what physical buyers are actually paying. That is not a normal premium. That is a structural divergence. Here is why that matters. Paper markets are built on contracts, futures, ETFs, derivatives. Most of them settle in cash. Very little metal actually changes hands. The price you see on your brokerage screen is based on financial engineering, not necessarily on physical delivery. But when real buyers show up with real money and demand actual metal, the physical market becomes the truth teller. Right now, physical buyers in Asia are paying prices that are dramatically higher than Western futures markets. And many small distributors are reportedly refusing to sell. When dealers do not want to part with inventory even at record prices, that tells you they believe the next move is higher. Why would they think that? Start with geopolitics. The conflict surrounding Iran has created direct risk to the Strait of Hormuz, a passage that carries roughly 20% of global oil trade. Insurance premiums on oil tankers have jumped sharply. Some vessels have anchored instead of sailing. 2 ships were attacked near the entrance of the strait. When insurance companies price in war risk, oil flows effectively slow down even if the waterway is technically open. Oil is the bloodstream of the global economy. When oil supply faces disruption, inflation risk spikes immediately. Transportation costs rise. Manufacturing input costs rise. Food prices follow. And central banks, especially the Federal Reserve, are already constrained by massive government debt and high interest costs. They do not have unlimited room to raise rates aggressively without triggering financial stress. So you have a negative supply shock layered on top of a fragile monetary system. That combination is historically bullish for precious metals. But this is not just about war headlines. Silver was already tight before any missiles were launched. Industrial demand for solar panels, electric vehicles, data centers, and advanced electronics has been climbing. Mine supply has struggled to keep up. Exchange inventories have been trending lower over time. Lease rates in the silver market were rising even before this weekend's escalation. The system was already under pressure. Gold has been setting record highs for months. Central banks have been accumulating gold at the fastest pace in decades. When institutions with unlimited fiat currency choose to buy physical gold instead of government bonds, that is not random. That is a statement about long-term trust in paper assets. Now add a geopolitical shock to that environment. Money moves fast in moments like this. Portfolio managers who were considering increasing precious metals exposure now feel urgency. Hedge funds that were neutral may flip long. Traders who were short silver at lower prices may be forced to cover if futures gap higher when markets open. And because silver's market size is much smaller than gold's, percentage moves can be extreme. Let me explain something important about weekend gaps. When markets close on Friday and reopen Sunday night, any major event that happens during that window creates compressed demand. Investors cannot react in real time. They watch the news. They see oil spike. They see physical premiums rise. They see tokenized gold trade higher. But they cannot execute trades on traditional exchanges, so buy orders stack up. When futures markets finally reopen, that built-up pressure releases all at once. The opening price is not a gradual climb from Friday's close. It can jump instantly to a new level that reflects 48 hours of accumulated fear and recalculation. That is why dark market prices matter. They give you a preview of where paper markets may need to adjust. Now, I want to be balanced here because credibility matters. Weekend prices often overshoot. Liquidity is thinner. Volatility is higher. When full market participation returns, some of that premium can compress. We have seen futures gap up before and then partially fill those gaps. It is possible that gold does not open at 6,000. It is possible that silver does not immediately print 120 on Western exchanges. But here's the key question. Even if the open is lower than the weekend highs, will the floor be higher than Friday? That is what you need to watch. If physical premiums remain elevated in Asia, if oil continues holding gains, if insurance rates stay high, then the structural pressure does not disappear. It may fluctuate, but it does not vanish. 3 assets matter most in this environment: gold, silver, and oil. Gold is the monetary hedge. Silver is both monetary and industrial, making it more volatile. Oil cannot be printed. When all 3 move together, it signals something deeper than speculation. Another factor most people ignore is currency confidence. The United States runs large fiscal deficits year after year. Interest payments on national debt consume a growing share of federal revenue. If inflation reaccelerates due to energy shocks, the Federal Reserve faces a brutal trade-off: raise rates and risk recession or financial instability, or tolerate higher inflation and weaken purchasing power. Precious metals tend to benefit when that kind of policy trap becomes visible. Let's talk scenarios. If tensions de-escalate quickly and shipping through Hormuz stabilizes, metals may pull back from extreme weekend levels. But investors have now been reminded how fragile the system is. That memory does not fade overnight. Allocations to gold and silver may remain structurally higher. If strikes continue for days and energy infrastructure remains at risk, oil could move significantly higher. That would increase inflation expectations. In that scenario, gold pushing towards 6,000 and silver holding triple digits becomes more plausible. In a more severe escalation, where regional conflict widens, safe haven demand could accelerate beyond current projections. Central banks may increase purchases. Retail investors may rush into ETFs and physical dealers. Short positions could be squeezed aggressively. In that case, volatility will not be mild. It will be historic. Now, I want you to think carefully about your own positioning. Are you diversified across asset classes? Do you have some exposure to hard assets that do not rely entirely on digital brokerage systems? Are you prepared for sharp moves in either direction? The worst decisions are made emotionally during fast markets. At Past and Profit, our mission is simple: connect the dots between geopolitics, macroeconomics, and your financial future. Not with fear, not with hype, but with clear logic. Right now, the logic says this: physical markets are signaling stress. Dark market gold touching 6,000 is not random. Silver trading at 120 in physical hubs, while Western paper sits far lower, is not normal. Oil facing functional disruption through insurance and tanker hesitation is not minor. Whether these levels hold or retrace slightly, the message is the same: risk has repriced. As we move into the next trading session, watch the gap on gold and silver futures. Watch whether silver closes the premium gap with physical markets or whether physical markets compress toward paper. Watch oil, watch bond yields, watch the dollar. This week could define the next phase of the metals cycle. Before I wrap up, I want to hear from you. Do you think gold will officially break 6,000 in the coming weeks? Do you believe silver can sustain triple-digit prices if tensions remain high? Drop your prediction in the comments. I read them, and they help guide future analysis here on Past and Profit. If this breakdown gave you clarity, share this video with someone who needs to understand what is happening beyond surface headlines. In times like these, informed communities matter. Silver at 120, gold at 6,000 in dark trading, oil under pressure. Markets about to reopen. Stay focused, stay disciplined, and I will see you in the next update.